Hi guys, welcome back to my YouTube channel. Today I'm giving you the taxes you need to be aware of as a property investor, the 5 key taxes that you need to watch out for. But first, please make sure you do give this video a big like and hit that subscribe button with notifications turned on. Okay, so hi guys, in this video we're talking about property taxes, making sure you understand the 5 main taxes that apply to property investment here in the UK. So what are the taxes that apply to property? Well, in no particular order, we've got stamp duty land tax, income tax, corporation tax, inheritance tax, and capital gains tax. So as you can see, we are contending with quite a lot when it comes to investing in property and also being tax efficient at the same time, because we've got so many different taxes that can apply in a variety of different ways. So the purpose of this video is really to run through typically how these tend to apply and give you a high level overview of what these taxes are and how you're likely to encounter them as a property investor. So the first tax to run through is stamp duty land tax. Basically, this is paid when you purchase a property, and it's also paid on certain transfers. But for most people who are property investors, you're going to pay this when you purchase a property from somebody else. So it's paid by the purchaser. This is going to apply whether you're in an individual, partnership, limited company. Usually, no matter how you purchase a property, even in a trust, you'll be liable to stamp duty land tax. And also, it applies at a variety of different rates. There are many calculators available online. It applies in a tiered system. But one thing to mention is you've got the 3% surcharge, which applies. And this is where you own another property in your own name. And by default, it also applies to all limited company purchases, this 3% surcharge. So make sure you are taking that into account in your calculations when you're purchasing property. It's definitely worth mentioning that there are various reliefs available, such as probate relief, if the property is uninhabitable, if there's a link in chain. There are quite a few different reliefs available, multiple dwellings relief. So definitely watch out for this and make sure that you are getting specialist advice, because your solicitors, your conveyancers are not tax advisors. And often you'll see in the letter of engagement between yourself and your solicitor that they do actually exempt themselves from basically saying that you must get professional advice. They say in their engagement letters that they're not responsible for this if you look at them. So that's definitely something to bear in mind, and make sure you are getting professional advice. So now we've got income tax. This is basically what is paid by individuals investing in property in their own name. So if you've got property income where you let a property in your own name or a partnership, it's definitely worth mentioning that you do have your personal allowance. This applies to all of the income you receive in a tax year: employment income, dividends, property income. You've got that £12,570 personal allowance, which is the amount you can receive tax-free each year. Also, you do have to file your self-assessment tax return. So if you've got untaxed property income over £1,000, this is called the property income allowance. So if you've got income under this and you do not currently file a tax return, you shouldn't need to. But if you've got income over this amount, you will need to file a tax return by the 31st of January. So obviously we can't ignore the big one here. Section 24, mortgage interest used to be an allowable expense for income tax purposes, which meant when it comes to calculating your profits, you'll be able to deduct mortgage interest and pay tax on the end amount. Now, due to Section 24 taking full effect, the way it works is mortgage interest is not an allowable expense for income tax purposes. You're simply given a 20% tax reducer equivalent to the amount of interest that you've paid. There are various caps on this. We've done previous videos in the past, but it's something to bear in mind. And this is why a lot of property investors have moved away from investing in their own name. And as a result, the income tax on property income is becoming less relevant. But that's, of course, not to ignore that when you've got a limited company, extracting the funds, you will again be subject to income tax on salary, dividends, interest when you're taking money from a limited company, which you might use to invest in property. So third, we've got corporation tax. This is paid by limited companies. Currently, the rate is 19%, but this is increasing to 25% from April 2023 onwards. This is the main rate for limited companies with profits under £50,000. Providing you've got no other associated companies, you will still have the first £50,000 worth of profits taxed at 19% and then increasing and so on. Do check out other videos on the YouTube channel, because we've gone into this in a lot more detail. And again, as I mentioned previously a moment ago, it's separate to income tax. So when you take funds from your limited company, whether that's a salary, dividends, interest, rent payments, you're going to be subject to income tax again, potentially, when you take them on your personal level. So your company will pay corporation tax, and then you, when you receive any benefit, any funds from your limited company, will potentially be liable to income tax again. Capital gains tax, where you sell a property in a limited company, corporation tax will apply to that gain. That's a question we get asked quite often is, does capital gains tax apply for a limited company? Well, technically the answer is no, but you will pay corporation tax on any capital gains that arise in a limited company. Inheritance tax, this can be an easy one to overlook simply because people want to believe that they are immortal, they don't want to plan ahead, they don't want to think about these kind of subjects. But you do get your nil rate band of £325,000, and also you have your residential nil rate band of £175,000, which is where you leave your home to a lineal descendant. This will become available. It's worth mentioning that for inheritance tax, it's based on the net values. So after you've taken away any mortgages, so just because you've got £1 million worth of property, if you've got £750,000 worth of loans on those as well, for inheritance tax purposes, really we're looking at £250,000. The rate applicable on death is 40% on amounts over and above the nil rate bands. So it's a very, very steep tax, simply because it can apply on all these different properties, the values of company shares and whatnot. And at 40%, it's going to be difficult to find the money to actually pay those liabilities. There are some reliefs, usually for trading businesses. You've got business property relief, but that does not apply to property investment, but it can apply to property development. So that's definitely something that's worth considering. So last but not least, we've got capital gains tax. This applies when an individual sells a property in their own name. And it can also apply, or it's quite interesting, a lot of people will often overlook, where you transfer properties from your own name to a limited company. If you're looking to incorporate, capital gains tax will apply there unless you've got some kind of exemption such as incorporation relief. The annual exemption, £12,300. This is the amount of capital gains you can make each year without incurring a tax liability. So this is basically equivalent to your income tax personal allowance. It's worth mentioning that you do have different rates of capital gains tax. For residential property sales, it's 18 and 28%. 18% where it falls in your basic rate band, and then 28% when it falls into your higher or additional rate bands. Really, when it comes to maximising expenditure, the best thing you can do is plan ahead, make sure that if you've got a lower income earning spouse, you can use their capital gains and exempt them out by transferring them part of the property potentially, and then keeping good quality records. Often because the amount of time between a property purchase and the disposal is going to be a significant number of years, decades, paperwork and invoices do get lost. But make sure you're keeping details of all of the solicitor's fees, surveyor's fees, stamp duty paid, any improvements that are still reflected at the time of sale, because all of these expenses are tax deductible for capital gains tax purposes, which are going to lower the amount of tax you do pay. So I really hope you've enjoyed today's YouTube video showing you the 5 taxes that apply to property. Make sure you do give this video a big like and also follow for more awesome tax saving content. We are posting 3 times a week around 7 o'clock, Monday, Wednesday and Friday. It's my goal to help you guys be as tax efficient as possible. Bye for now.